Hello, I think we are live now. It's just a minute. Yes, thank you. I think we have 3 people. Let's give some a little bit of time, wait for a few people to join us, and then we can start. Great. So I think we are going to start. We are already 7, and that's a good number to begin with. My name is Eunice Maina Mburu. I'm the CEO and founder of Bismart Insurance. It's an insurtech, or rather an insurance that use a digital company that enables customers to compare insurance from multiple insurance companies and choose the right insurance for themselves. Please feel free to be typing your question. I hope I'll be able to see them as you type, but we'll answer all the questions today. Yeah, so I was saying that Bismart is an insurtech that enables customers to compare insurance policies from multiple insurance companies. Say, for example, you are buying a car insurance and you want to know which is the best company. So what we do at Bismart is that you can actually just go to bismart.co.ke, you will put in your name, the value of your car, the year of manufacture of the car, and then we will provide you with available options for your car. So that will be different insurance companies, and you can be able to choose not just based on price, but also based on benefits, exclusions, what normally people complain that they don't get to know about insurance. And so Bismart started in 2017, July. So we are slightly above 4 years serving our customers and just making the buying decision easy for our customers. And that's what we want to keep doing so that then there will be no complaints. Our vision is to enable customers to actually buy insurance without, the friction that exists. The other thing that we do is we design products that are relevant because we are able to interact with many people. We are able to design products that are relevant, that customers are asking for. Some of the products that we've designed are Afya Smart. Afya Smart is a Mchango health insurance policy where you come together. You don't have to be related. You can come together yourself, your cousins, or your brothers and sisters, or your family alone, or even you alone. You can just buy a cover and share the benefits. So you're able to share the premium. Say, for example, if you want to buy a cover of an inpatient of 750,000 and an outpatient of 100,000, then what you do is that you will pay 40,000, 4 of you. So it could be you and your 3 other friends. You pay 40,000, so each 10,000. Or you could take as a family. So a family of 4, that would be still 40,000. And you can decide you don't want to share with anyone. So you just pay the 40,000 alone. So that is Afya Smart. The other product that we have designed is the one we recently launched with Britam. It is called Elimu Smart. Elimu Smart, it's actually as smart as we call it, because we looked at the existing education policies in the market, and we realized that most of those policies, you have to save on a monthly basis. And sometimes when people lose jobs, then they also lose the insurance, and even they lose the amount that they had saved. So what we did is to ask, can people invest elsewhere? Can you be able to invest not necessarily on insurance, but can you be able to invest your money maybe in land, in property, in your business? But the only issue you have is that in case of death or disability or critical illness, then it will mean that your children may not be able to sell the property you have invested on time, or they may not be able to liquidate your investments on time. So this product, Elimu Smart, is designed for people who just want to secure the school fees for their children. And it's just like your car insurance. So you pay on an annual basis. And, depending on the school fees you pay, if you're paying 100,000 school fees, you pay about 2,000 shillings per year to guarantee that school fees. And why did we do this? One thing that I realized is that the death of a parent is painful. But if children have to be moved from school, then it's more painful for the kids because they lose their friends. The other thing is that, we are very good at going for burial and making declarations and saying, your children will not suffer because we're going to support them. But 3 weeks down the line, the kids are on their own and they need to go to school. And if you had property, then it's subjected to their they have to go and get the letter of administration. The guardian has to get the letter of administration for them to access those property. If you had money in the bank, they have to seek, to get the letter of administration for them to be able to liquidate, or rather to access that money. So this Elimu Smart enables quick access to the school fees for the kids because the money is readily available and it's not subjected to the letter of administration. So I don't know whether we have any question. Who do we have here? Let me see. Okay. Yeah, there's no question so far. I hope there'll be more questions, but I will just start by answering some of the questions that people keep asking me. One of the questions that I get asked many times is, does comprehensive motor insurance cover me and my family, my wife and children? And I want to answer that question. What does comprehensive motor insurance mean? It means that your car is covered for any damages. So damages caused by other people and also damages that are caused by yourself. Say, for example, you hit a tree. That the comprehensive cover covers that. However, it does not cover you as the owner of the car. In case of an accident, it will not pay for your medical bills. It will not pay for your wife and your children. And the reason for this is because, you see, for any claim, for any third-party claim, when I say third-party, it means another person to claim from insurance, then they have to go through the court process. And the court process in this case means that somebody has to go and report, or rather sue you in court for the accident so that then the damages can be paid. So it's not expected that your wife will take you to court because you caused an accident, or your children. And that is why comprehensive cover does not cover you and your immediate family. And the other, let me see, I can see a comment here. Okay. The other question I would like to answer that people keep asking more often is the question of if, for example, you took a product like a Smart, and because you pay on an annual basis, an accident doesn't happen, or you don't get critical illness, or there's no death that has happened within that year, can you get back your money? And the answer is no, you cannot get back your money because, and I want to explain how insurance works in this case. What happens with insurance, and I'll use an example of many of you have got chamas or welfare groups, and you decide, say for example, you want to take care of someone in case they get sick. You would like to in case a person gets sick, you would want them to give them, say, 10,000 shillings. And for example, you're 10 of you. So the 10 of you will agree that in case one of us gets sick, we're going to give them 10,000 shillings because it costs about 10,000 shillings to treat that particular sickness. And so, say this in a span of 1 year. And if one of you gets sick, then they will get the 10,000. So we say that the one who has gotten the 10,000 will be very happy that you have sorted them at their time of need. And the other 9 who did not get, of course, they will be happy that they did not get sick because the money went to the individual who got sick. That is the same way that insurance works. It works at a principle of the fortunate many compensates the unfortunate few. And that is why you don't get back your money, because the money has already paid for those who got that particular situation. If it's a car insurance, why you don't get back your money is because the money has been utilized to pay claims for the others who got an accident. So you'll find like you haven't gotten an accident for a while, but other people did. And that's how insurance works. The other question I get asked a lot is, can I normally I'm normally asked about the waiting periods when it comes to health insurance products. What does waiting period mean? And I would like to answer that. Waiting period means that it's basically during the design of a product. The products are designed such that to reduce the cost of the product, the person buying the policy contributes. Now, in motor insurance, the person contributes what is called excess. Excess is that amount that you also contribute to this particular loss. That lowers the cost of your insurance. So waiting period is now not in monetary form, but it is in time format. So we can call it an excess of time, because it's saying that we are taking this risk from you, and you also need to contribute to this. So we set, say, 3 months waiting period, so that within those 3 months, you do not make a claim. You're not allowed to make a claim. So some waiting periods will be based on critical illness. Other waiting periods will be based on maybe death. So the waiting period is that time that you also contribute, or we can call it excess of time, if you understand what excess is. So I can see some questions here from Rachel. Please enlighten me on endowment policy, where the insured survives the entire time and the payment is once at the end. assured time, say 10 years. Good question here. Okay, what is endowment policy? I will answer that question in a longer perspective. I will start by, mentioning that we have different types of categories of insurance. We have the general insurance categories, and we also have the life insurance category. And so endowment policies are life insurance policies. Now, under life insurance policy, we have pure life, or what is mostly called as whole life policy. We have term life, and we also have endowment policies, or rather endowment life. So I will start by explaining endowment life. Endowment life is whereby you take a cover and it has a limited time. It has a set time limit. It's a long term, but it is it has a timeline. Say, for example, 10 years. And when you take a particular policy, mostly you find them in the current education policies that are in the market. So if you take a policy for 10 years, it means that in the event, say, of death, or disability, or whatever circumstance that is covered, in that event, if that event happens, that endowment policy will pay. Now, if that event does not happen, it means that after 10 years, you will get some cash back. Okay? So endowment policy, we can say, is a policy that can pay either on maturity of the policy or on the event that is insured happening. And it has a limited time. So I don't know whether I've answered you correctly, satisfactorily, Rachel. The other life policy is what I mentioned, called the pure life or the whole life. Now, the whole life policy, you pay until death or until that situation happens. Say, for example, if you've taken a pure life that covers you in case of death or in case of disability or in case of critical illness. So you will keep paying. Even if you live 60 years or 80 years or 100 years, you will pay until that event happens. So this cover can only pay on the happening of that event. And it has no limitation when it comes to time. It's whole life. Okay? It's throughout your life. And the other policy that I want to explain is called the term life. The term life means that it's a very short time. The term is short, mostly annual, and hopefully we will be able to design some for monthly, but it's normally 1 year term. So this cover, you'll find that term life is renewed every year. So you'll find policies like funeral expense, or rather last expense policies, are term life. You will also find like the Elimu Smart that we designed is a term life because it expires every year and you have to keep renewing, just like the way you renew your car insurance. So that's term life. And some term life, for example, when you take a mortgage, you are also the bank or the person giving you the mortgage ask you to take a cover. It's normally a term life cover, and it reduces, the term reduces as the year progresses. Say, for example, you took a mortgage for 15 years, so your term life cover will be reducing every year, so from 15 to 14. And that's the same way we have done with our product, Elimu Smart, that if you take, say, for example, your child is in class 4, and you've taken for up to class 8. So the moment they move to class 5, the number of years covered reduces to 3. And then when they go to class 6, they reduce to 2 until the time they finish class 8. So I believe I've answered you well, Rachel. But if I've not, please let me know. There's another question here. If the comprehensive insurance don't cover immediate family, is there one that covers? Very good question. Yes. Yes, there are covers that cover your immediate family. And we advise that when you take your car insurance, please take what we call a personal accident cover. Because you've covered your car in case of an accident, but you've not covered you and your family in case of an accident, especially when you get an accident, you get injured. There will be hospital bills that relate to that. So there are several policies you can take. You can take a personal accident cover that will cover you and your wife and your kids. And the beauty with a personal accident is that it also, in case of disability, it also pays cash. In case you got disabled and you're not able to earn an income, it pays you cash so that you can be able to survive the rest of your life. So the more the more the benefits you take, the better for you. Another cover you need to take is the medical cover, a health insurance, because in case of an accident, then you'll need to go to the hospital. So a health insurance comes in for you and your family. And this is new. I've talked about it. The Elimu Smart. If you have children and they are going to school, please take Elimu Smart cover, because then in case of an accident and you're disabled, or in case you're diagnosed with a critical illness, that policy will pay school fees to the school your child is in. So those are some of the policies that you can take. Please let me know whether you're satisfied with the answer, Ariana and Rachel. Okay. Somebody, Gashero Martin, is asking, please repeat for me Rachel's second question. I was off. Rachel's second question was about endowment policy. She asked, enlighten us on endowment policy. And I was explaining that an endowment policy is a policy that has a time limit. Yes, it's long term. It's not 1 year. At least the ones that are currently in the market are 5 years and above. And it either pays on the event that is insured happening, or it pays on the in case of maturity. So what it means is that if you have taken a cover for 10 years, at 10 years it matures. So it will pay the amount that was agreed that will be paid to you on maturity. And in case of death or disability, if those are what was insured, in case it happens, then it will also pay. So it pays on either occasion. The second question, Rachel, which was it? Okay, and you paid some. Are you paid sum assured? I saw it less than total premiums paid. Or do you get the maturity estimate? Oh, good question. Sorry, I've not seen that. Are you paid sum assured? Yes, that's a very good question. Sum assured is the amount that is guaranteed for you when it comes to endowment policy. Now, sum assured is not equals to the premiums paid. It's not always equals to, and it is not always more than the premiums that you have paid. So you will find, depending on the age, so the older you are, the more premiums you pay, and the less you will get when the policy matured, or rather matures. So you'll find that, say you've taken a policy, you're paying 10,000 per month, and you're paying for 10 years. So by the end of the 10 years, you'll have paid, say, 1.2 million, right? Is it? Am I correct? Yes, 1.2 million. And maybe the sum assured you have taken is only 700,000. So the policy will pay 700,000, not 1.2 million. I hope I've explained clearly. That is why it's important to ask yourself, when I am buying an insurance policy, what do I want? Am I buying as an investment or as a savings, or am I buying it as a protection? You know, is it just protecting my family in the event something happens? Because if you're buying it as a protection, then you can do savings in a better place. And that's why it's important to look at, what policy do I need? And this depends on your risk appetite. It also depends on what you're doing. If you're not disciplined at saving, maybe you may need an endowment policy. If you don't know where to invest the money, then you can either come to us, or you can just take an endowment policy. It's an easy way to sort your yourself out. However, if you know, for example, say you're in business and you know that this 10,000, I can be able to multiply it in business. However, I don't know the day. The Bible says that we do not know the day. Because I don't know the day, and I don't know what the risks I'm taking could lead to, then I need to secure. I need to be able to protect my family from any eventuality that may happen to me as the breadwinner. So instead of paying 10,000 per month, I will go and take, for example, forgive me, I'll keep referring to the Elimu Smart. I'll go and take Elimu Smart that in case this will protect my children's school fees. And I will also take a personal accident, just in case of an accident, to pay me a lump sum, and if I'm disabled. And or I can take a pure life cover. So it really depends on your goals. What do you want to achieve? If your goal is savings, then just do your maths, ensure that whatever you're contributing as premium is going to be more than, or rather, whatever you will get back in 10 years is more than what you have contributed as premium. I want to explain something here. Why your sum assured, or rather the amount, the maturity value, let's call it maturity value, I think. The maturity value is the amount you get at the end of the term. Why sometimes it will be less than the amount of premium you pay is because when you pay premium, it is split into two. Part of the premium goes into risk, or rather what we call protection. Basically, in case, what you're talking about, in case of death or disability or critical illness. And then the remaining part, it's actually split in several times. The remaining part goes to what you're saving and also the administration of this policy. Okay? So that is why you'll find, especially if you're older and you're taking a shorter term, whatever you receive is normally less than what you have paid. Any other question? Lashero, I hope you had it this time. Let me see whether there are any other questions. Okay. Rachel, if I survive, me, myself, am I paid sum assured or maturity estimates? Very good question. There are many terms that are very confusing when it comes to insurance. Because now Rachel raises the issue of maturity estimate. So there are some policies you will take and it is written maturity estimate. Please note, it's an estimate. It's not a guarantee. Okay? It's what is estimated. It could be higher, it could be lower when it comes to the end of the term. And mostly, now I'm introducing another jargon. It happens to these products that we call the unit-linked products. It's where you'll find mostly maturity estimates or estimated maturity value. So you'll find that. So if you survive, you and yourself, you will be paid the maturity value. Not the sum assured, but maturity value. Maturity value is the value of that policy at that particular time, especially if it's a unit linked. The value depends with where the money has been invested. And remember, the value excludes the amount that went to the insurance bit in terms of protection. It also excludes the administration fees for that policy. So it is now what remains plus where it has been invested, then you get the maturity value. Now, there are some policies that guarantee a particular amount. It's very important that you read your policy document. So your policy document says after 10 years, you'll be paid 1.2 million. That will be the guaranteed value. That is what you will get. If it's not written estimate, then it is guaranteed. Okay. What did I want to say? Yeah, so that is, there are many terms. Let me answer Ariana's question. Kindly educate more about business and staff's cover. I don't know. Okay, I'll start with business. When you talk about a business, so you have opened a business and say you're selling, say, computers. So there are several insurances that you need to take. So first, you have the computers. In case of fire, or in case of burglary or breakage, you're likely to lose your computers. So you need to take a fire insurance. And also actually it's a stock insurance. You will take insurance for the stock that is within the shop. That is if you have tangible things in your shop. So you take the stock insurance. In the stock insurance, there is fire and there is burglary. And there is another cover that covers goods that are mobile, called the all risks. Say you are in an office, and in your office you provided your staff laptops. So the laptops will be covered under all risk cover. When I say all risk, it doesn't mean every risk. and this is why insurance confuses. It means because this laptop or this mobile phone, staff are moving in and out with them, then it will cover in case it is stolen in their car or it is stolen in their house. So that is what we are talking about, all risk. Or if it is damaged by floods, or any other, kind of a damage on the laptop. Okay, so we've talked about fire, we've talked about all risk, we've talked about burglary. There's also another insurance, especially if you own a building. There's what is called the public liability insurance. Because if you own a building and I walk into that building and God forbid I broke my foot, I will sue the owner of the building. So you need to get a public liability cover. What else about business? So there is the stock, the fire, burglary, all risks. And the other, now let's come to the staff of the business. So for the staff that are working for you, you need the first cover, which is actually statutory requirement, is WIBA, Workman's Compensation Insurance Benefit. Now, this is, you see, the law requires that if you have employed people, say you're running a restaurant, and you have waiters and you have cooks, if there is fire and they get burnt in your premise, it's your responsibility. So they will sue you and you will pay them damages. Now, what has been decided by government is that you pay 8 times their annual salary. So if somebody was earning 10,000 per month, it means you will pay them 120,000, that is 10,000 times 12 times 8. So mostly if they go to court, that is likely to be the amount that you have to pay. So what you do is, instead of waiting for such an event to happen, because it can affect 1 or 2 staff, it's important that you take the WIBA insurance. If you don't have insurance and you're asked to pay, this is almost $1 million shillings, for one staff. So, for example, if there are two, it means you're going to pay 2 million shillings to the staff. So it's important that you insure on WIBA. The other cover that you can take for your employees is not a statutory requirement, but it's a good benefit to give to your staff, is the medical cover, the medical insurance. The medical insurance includes inpatient, this is in case of admission, and also outpatient is dental, maternity, and all this. The amount of premium you pay depends with the amount of cover that you want your staff covered. So for you to get a health cover for your staff, what you do, you need to provide us with how many staff do you have, and how many dependents does each staff have. And if you do that, you'll be able to get a comparison quotation from different insurance companies, and you'll be able to see which one gives you the best benefits. Yeah. Oh, another question here. I don't know whether I've answered about the business. I've talked about WIBA, health. Oh, there's another cover that for business that you can take. Is also called a group life cover. A group life, you notice that health cover pays for hospital bills. WIBA covers in the event an employee is injured within the work premises, or when they are coming to work. If they can prove that they were coming to work or they were coming from work, then WIBA will pay for that. However, if they were not at work, they were outside work, or the situation is not as a result of the risks involved at work, then the WIBA will not pay. And that is why it's recommended to take a group life insurance cover. Now, the group life insurance cover will cover whether they're at work or out of work. And it also includes a critical illness cover. Please note, WIBA only covers accidental covers, or in case an illness is obtained. Say, for example, they're working in a pharmaceutical company and the drugs, affect the person and they get a disease, then WIBA will pay for that. However, if it's just a natural sickness that is not related to the environment they work in, then that is why you need to take the group life cover to cover for that. And most of the group lives will come with what we also call a group personal accident. Now, we have said WIBA only insures when you're at work. A group personal accident insures whether they're at work or out of work. So if an accident happens in their house, then they're still covered. So it's good that you engage to understand what is the best cover for your business. I think with that, I've covered the business covers that are available. And then I need to answer a question from, thank you, Rachel. I can see satisfied, well explained. Rachel, again, can I get medical cover for outpatient only? Very good question. Very, very good question. Let me say this. Outpatient, okay, let me start by saying currently, the products that are available in the market, no. However, if you have a big group and you want us to design, and when I say a big group, I'm looking at thousands, we can design something for outpatient only. But as of now, as we talk, you will not find an outpatient cover only. And the reason is we do not consider outpatient. When I say we, I mean the insurance sector, the outpatient and insurance. Now, I need to explain what insurance is. Insurance is, or rather, it's a risk transfer mechanism whereby you transfer your risk to an insurer, that in the event of an unforeseen situation or uncertain situation, unforeseen, uncertain, unpredictable. Any event that is like that can be insured. Now, outpatient, it's dicey because many times, and this is actually the customers who misuse it, because you have an outpatient cover, then even when you don't need to go to the hospital, you just go because you have it. So we normally see it like a guaranteed claim. That because you have, so long as people have outpatient, they will go to the hospital. So that is why we do not have many products that offer outpatient only. Inpatient is actually a big risk because it's unlikely that you will go and admit yourself to the hospital unless you're really sick and the doctors can see that. I hope I've answered you, Rachel. Is there any other question? Okay, there are no other questions. And it's now 12:47. We were supposed to end at 1 p.m. I'm just going to just wrap it up and say that there are many questions I know people have, and we can be having this every Thursday. We can have this moment of just questions and answers, and you can ask anything, just anything about insurance, and we are available to answer that. And my advice is, before you buy any cover, please understand what it is you're buying. At Bismart, if you go to bismart.co.ke, you will be able to see, like if you're looking for health cover, you'll be able to see the different companies, what they're offering, what exclusions they have, and next time we'll discuss exclusions, what they are, what waiting periods they are offering, and what price, so that you are able to buy based on information. Don't just buy blindly. And that's the reason why we designed Bismart platform, so that you can buy based on, information that is simplified and credible. So with that, I think we call it a day, and let's meet next Thursday, same time. Start thinking about the questions you have about insurance, what you hear, all the myths that you have about insurance, and let's bring them here and let's have that conversation. So thank you very much. I can see the link for the website is there. Please go to that link and just buy. It's a supermarket of insurance. Just choose the products you want. And our team is available actually to even chat you on live chat. The website has got a chat. You can chat them on live chat. They can call you. You can call. Just anyway, just reach us and we will guide you accordingly. So thank you very much. Have a great day.